So hi everyone, welcome back. In this new lecture, we are going to start with question number 71, and before that we are going to discuss about the concept of duration. So before moving over to the concept, let's first go through the charts. And if you will see, there is the fourth concept, which is bond valuation. It has in total 11 sub parts. 11, right? So let's start from the first one. The first one was structure, face value, coupon rate, maturity, YTM, market price, redemption price. Everything have been discussed in the past questions. This is going to be related to the theory. You can understand. We have seen some zero coupon bonds. This will be a bigger topic later on, convertible bonds. Then we have seen some callable bonds and puttable bonds as well. Third part is related to the yield. We have seen this formula, current yield is equal to interest by market price. If you remember, we have also seen this YTM average method, or we can calculate it by IRR method also. Bond valuation is nothing but the present value of future cash flows. That has also been discussed. And the fifth part comes to the duration. The other name to the duration is the Macaulay's duration. This is the person who invented all this thing. So what is exactly duration? Duration in bond valuation is the weighted average number of years or time in years where you are recovering or receiving the present value of future cash flows. So I don't think so this is going to be enough to understand the concept. So let's first take some rough figures. Let's say there are 5 years with a bond, and some details like this: 1000 face value, coupon rate 10%, and let's say YTM is 15%. Or instead, let's make it simple: 7% coupon rate and YTM is 10%, time for 5 years. Okay, 1 2 3 4 5. Let's write down the cash flows here. On the first year you will get 70 rupees, then 70 70 70 and 1070. Am I right? For all the 5 years you are going to get the interest, and in the 5th year you are going to get the redemption value, that is the face value back. Okay, these are the cash inflows to you after you invest in this particular bond. And now let's calculate the present value of it at 10%. 0.909, 0.826, 0.751, 0.683 and 0.621 are the present value factors. If you write down the present value, it is like this. Till this point we have learned how to do all the calculations. I am writing it 63.63. You might say that, sir, if 70 is being repeated so many times, why are you doing the individual calculation for the present values, and why not the annuity formula? I will just tell you that in a minute. 47.81, 664.47. let's do the total of this. $47.81, 664.47. So that goes to 819.04. So theoretically speaking, this should be the theoretical market price, or we can say present value of future cash flows. Am I right? 819.04 rupees. Now this is the present value of this bond. 1 2 3 4 5. Present value of this bond is 819.04, and then every year you will receive 70 70 70 70 and 1070. Okay, so if the bond is traded at fair value, the fair value is 819.04, the actual market price will also become 819.04. If the bond is traded at fair value, actual market price will also be 819.04. The concept of duration is you need to find out in how many number of years, in how much time this present value is recovered. This amount that you paid is recovered. So 819.04 is recovered with these cash flows. Are you sure about it? Yes, sir, because we calculated this amount based on these cash flows only. Can you tell me exactly in how many years, weighted average years, not just the number of years, you recovered this amount? In exactly how many years? You can clearly say that somewhere between 4th and 5th year 819.04 is being recovered. But tell me one thing, these are 5 years and we don't want simple calculation. We want weighted average years. That means every year will get respective weight based on the percentage of recovery. Now, understand one thing. I will just write down weight here. What kind of weight? The total value is 819.04, and in the first year, out of this 819, am I right if I say that I have recovered 63.63? So 63.63 divided by 819.04 will give me the percentage recovered in first year of the total, right? And this way, if we keep going on and on and on and on and on, we can get 100% recovery of this 819.04. So what I'm going to do the next is calculate the weight of the present value. Why just the weight of the present value? Because we want to find out in how many years this amount is recovered, the present value. So if we want to calculate the years of or we can say if we want to calculate the number of years in which this present value is recovered, we will have to take the weights of these present value also. What kind of weights? Sir, weight of the total. Okay, let's do the calculation. 63.63 divided by 819.04. If I do this, it means into 100. It means I have recovered 7.7689%, or in decimal I will write it down like this, 0.0777. So I can say 7.77% has been recovered in the very first year. This is the weight. Now for the second year, just repeat that. 57.82 divided by 819.04. Or I can, I know that I will have to do it, this divided by 819.04 all the time. So what I can do, I can just place it in the memory of the calculator first and then keep pressing all the numbers. So see, 1 divided by 819.04, 1 divided by 819.04 multiplied by now all the numbers, 57.82, 0.071, 52.57, 0.0642, 706, we can make it 706, second one. Okay, then put it like this, 47.81, and then only equals to button, 0.0583, 664.47 and equals to button, 0.8113. See, what I am doing is, once I place in the calculator like this, I will just give you the calculator trick. 1 divided by 819.04. Okay, then I just typed or pressed these buttons on the calculator and then pressed multiplied by 63.63 equals to, I got the answer of 0.0777. All the data is as it is in the calculator, and then I'm pressing directly, nothing else but this, 57.82 equals to 52.57 equals to 47.81 equals to. All the time these two functions will be automatically done by the calculator. 1 divided by 819.04 and into. You just have to press these numbers and equal to, numbers and equal to, numbers and equal to. Okay, so these are the weights. What does this represent? This represents that how much of the total value, present value, how much weight of the total value you have recovered in the respective years. Now we want to find out in exactly which year we have been recovering. So what we are going to do, we are going to multiply the year with the weight. So this will be called as weighted average years. Weighted average years. 1 multiplied by 0.077. It will be 0.0777. Then 2 multiplied by 0.0706. 0.1412. Okay. Then 3 multiplied by 0.0642. 0.1926. 0.2332. 5 multiplied by 0.8113. So that's 4.0565. And now do the total. That gives us 4.70 years. Now understand what is happening here. This is the weighted average years, 4.70, in which your present value is being recovered. Present value of the bond is being recovered. Weighted average number of year. These figures gives you the weight, and understand the fact, in the 5th year the maximum percentage has been recovered, and that's why we have to increase the weightage of that. We have to make this 0.8113 in such a manner that we can call it as it has been recovered in the 5th year. So that's why we are directly multiplying it with 5, so as we can give it a maximum weightage in as compared to the rest of the figures. So that's why we multiply by 5 into the weight. 5 into weight, when we do it, you just calculate the weighted average years. It's not simple average. See, if you want to do the simple average, what you are going to do? You are going to just take 5, 1, 2, 3 and 3, 6, 6 and 4, 10, 10 plus 5, 15 divided by 5, because 5 years are there in total. So that will go to 3 years. That is the simple average of all the years. Simple average of all the year is 3. You do the total of 1 plus 2 plus 3 plus 4 plus 5 divided by 15. That will be simple average. But simple average won't give you exactly what amount is being recovered in which year. No matter what the cash flows for all the 5 years bond, this is going to be the simple average. So that is not going to work. If the cash flows are being received more in the initial year, the more weight for the initial year should be given. Simple. If, let's say for example, if 1000 would have been received in the very first year, at that time the weight for this would have been higher, isn't it? And the first year would have received a higher weight. That weight multiplied by 1 would have been the same. So in that manners we can calculate the duration. Are you getting it? How did we calculate the duration? So let me write down a couple of things first. Duration. What is the meaning of Macaulay's duration? Time in which, or in a better word, weighted average time in which present value of cash flows of bond is recovered or received. Simple. So how did we do that? Can we create a formula for that? Yes sir, we can do that. So first we calculated weights. First we calculated present value, then we calculated weights, and then we did weight into year. Weight into year, and then at the end summation of this weight into year. So the very first formula goes like this. Duration is equal to, first calculate weights, then multiply it with time, and then summation of this. Summation of weights, or instead of time we can say years. If you do this, you will get the same answer. The other method is also there, through which we can calculate, which shows that summation of present value into years divided by summation of present value. This is nothing but the weights only, weighted average only. You can just try doing it. Let's do that. This is the present value. Are you getting it? So the formula says that present value into year, from inside to outside you are going to follow the steps. First is the multiplication of present value into years, and then total of it. So let's do that once. I will just show you here. Present value into years. This is little lengthy process. 63.63 into 1. So if you don't want to calculate weight separately, what you can do is you can simply multiply the present value with the years. So 63.63 into 1 m plus 57.82 into 2 m plus 52.57 into 3 m plus 157.71 and 47.81 into 4 m plus 191.24 661.47, or we can say 661.47 m plus has been disturbed. 664.47 into 5, that goes to 3322.35. Let's do the total of all this. The first step was to calculate summation, multiplication of present value into year, and then the summation of that. Have a look. It gives you 3850.57. So you have summation of present value into year. You also have summation of present value. Let's find out. 3850.57 divided by 819.04. 4.70 years. It gives you the same answer, 4.70 year. Are you getting it? This is another method of calculating the same thing that we have been doing it. Now let me tell you another method. The third one. 1 plus YTM divided by YTM minus, again 1 plus YTM, you will put it in the numerator, then plus time in years, coupon minus YTM divided by coupon outside 1 plus YTM to the power T minus 1 and plus YTM. See, if you don't want to remember the logic and don't want to apply the brains, you can just mug up this formula. This is quite technical, so we are not going deep into this. But if you can mug up the formula, you will get the same answer. Let's try finding out. YTM means the yield to maturity, that was 10%. So 1.10 in the numerator, 0.10 in the denominator. Are you satisfied with this? Then minus 1.10 in the numerator plus 5 in bracket. Coupon rate was 7%, YTM was 10%. Coupon rate 7%, 1.10 to the power 5 minus 1 plus 0.10. Okay, let's try solving it. This is going to be 11. 1.1 divided by 0.1 minus 1.10 minus 0.07 in the numerator minus 0.10 into 5 will give you 0.15 divided by 1.10 into 2, 3, 4, 5 minus 1 into 0.07 plus 0.10. So all entire denominator comes to 0.1427. Let's try. 11 minus 6.6573, or we can say 6566. So that's 4.34 years. It should have been 4.70 exactly. There might be some mistake. Let me just try once again. 4.70 should have been the answer. 0.07, 0.10 into 5 plus 1.10, that's 0.95. Right. 1.10 into 2, 3, 4, 5 minus 1 into 0.07 plus 0.10, so 0.1427 in the denominator. 497, right? 0.95 divided by 0.1427. So there might be some rounding of error. The answer is right, 6.66. So approximately you can reach at the same answer with this. In the coming questions, we are going to see how this will give you the correct answer as well, exact answer. So this much of the difference will not be there as well. Okay, so these are the three formulas that you will have to remember. So coming over to the formula of the duration, we have seen this formula. This will be used most of the time. This is the weight of present value. Please write down in the charts itself, weight of present value into year and then summation. Weight of present value into year and then summation. Then summation of present value into year, this was the second formula. It will also give you the same answer. And this is the third formula. 1 plus YTM by YTM minus, here 1 plus YTM plus T in bracket C minus YTM. C means the coupon rate. C means the coupon rate. You will have to just use this formula multiple times to remember. This is another formula given in the institute's material, but we are not taking it, and I will also not suggest you to use this. This has not been used in many questions asked exam also. So follow these three methods and you will get the answer of the duration. Now we are going to focus on some questions where we will be calculating the duration, where I am going to again explain you the meaning of that. In a sentence, you can remember the duration is nothing but weighted average number of years in which the present value of the bond is being recovered. So, if you look at this table, 4.70 is the weighted average number of years in which this 819.04, that is the present value of the bond, is being recovered or received. Getting it? So there are three different formulas for calculating this. Have a look on question number 71. Now we are going to enjoy solving all the questions related to the bond valuation. So there are four different parts in this question and all the four questions are different. So it is going to take a little time to solve the entire question. Have a look. This was asked in June 2009 and it was also included in the practice manual. When it was asked in June 2009, it was for 8, 6, 3, 14 and 3, 17 and 3. 20 marks question was that. So a single question on bond valuation for 20 marks in June 2009. Have a look. Consider two bonds. Not just one, but two bonds. One with a 5 years to maturity and the other with 20 years to maturity. One is going to expire means mature after 5 years and the other one is after 20 years. Both the bonds have a face value of 1000 and a coupon rate of 8% with annual interest payments and both are selling at par. Underline the word selling at par. That means market price is equal to face value is equal to 1000. Assume that the yields of both the bonds fall to 6%. Okay. They are asking us to find out the current yield. They are saying that it will fall to 6%, but they have not given what is exactly right now before falling. What is given as 8% is the coupon rate. That is not the yield, it's the coupon rate. But yes, we can calculate the current yield or YTM very easily. Assuming that the redemption will be at par, if market price is equal to face value, coupon rate will be equal to YTM, which is 8%. So YTM will also become 8%. If you want to do the calculation, you can do it. The answer will be this much only. So that 8% of YTM will fall to 6%. Whether the price of the bond will increase or decrease, it's very simple. The price of the bond will increase because the YTM is falling. There is an inverse relationship with the market price and it will increase. Okay. We agree that the bond price will increase, but from the total increase, what percentage of this increase or decrease comes from a change in the present value of bonds principal amount, and what percentage of this increase or decrease comes from a change in the present value of interest payment. So this entire statement says that we have to find out how much the principal amount has changed and how much the interest has changed. What percentage of this increase or decrease? Let's say for example the price is going up by 100 rupees, and out of that 100 rupees 60 rupees is because of the principal and 40 rupees is because of the interest change. So we can clearly say that 60% is because of principal and 40% is because of interest. So we have to find out in both the cases, taking 8% as the YTM and 6% as the YTM, present value of principal amount and interest payment. See how we can do it. I will just do the first part, that is the bond with 5 years maturity. You will have to take care about the 20 years maturity bond. Question 71. 5 years maturity. Have a look. At, I can say 8% YTM. Market price will be interest into present value annuity factor plus redemption value into present value factor. Alright. Just a second. Okay. So what is the interest amount? 8% is also coupon rate. So 80 rupees into annuity factor plus at the end of 5 years we will redeem 1000 rupees and we will take the 5th year factor. So have a look. With 8%, 1 divided by 1.08 equal to m plus equal to m plus equal to m plus equal to m plus and equal to m plus. MRC 3.993. 3.993 is the annuity factor, and if you press one button up, 0.681 will be the factor. I was trying to start this small camera so that I can show you what I'm doing on the calculator. That will help you a bit, but I don't know if it's going to work today or not. Okay, nevertheless, let's continue. So if we do the calculation, 80 into 3.993, it goes to 319.44 plus 681. So the present value will be, we can simply just erase this part to cover up at 1000. Okay, so this is going to be the market price. This is exactly the market price given in the question. When coupon rate is equal to YTM, market price will also be equal to face value. Now if the YTM falls to 6%, what will happen? We will do the calculation again. 80 into plus 1000 into, let me do it again, 1 divided by 1.06, 0.747 will come here. MRC 4.212 will be written here. So 80 into 4.212 is 336.96 plus 747. 747. So it goes to 1083.96. Now have a look. If I write it down in present value of, first of all principal, no, first of all interest. Let's write down the first value as interest, then principal, then total at 8%, at 6%, and this will be the difference. Okay, let's write it down. 319 when it was 8%, 336.96 here, 681, 747. Okay, this was with a total of 1083.96. Now let's find out the difference. 319 minus 336.96, absolute figures, no negatives. 17.96, 681 minus 747, 66. So 66 plus 17.96 goes to 83.96. Now have a look on the difference. First of all, when we said that the YTM is going to go down from 8 to 6%, it was absolutely true that the market price will increase. So interest payment, present value of interest payment have increased, principal have also increased, the total market value has also increased. Now you have to tell us, out of the total increase of 83.96 rupees, how much is contributed in percentage by interest and by principal. So percentage increase in present value of interest payments is 17.96, 83.96, and percentage increase in present value of principal is 66 divided by 83.96. That's it, simple. With this 100%, we have divided how much is contributed by this and this. So the final answer will be 21.39 here and 78.61 here. Simple. This is in percentage. Let's have a look on the answer. 83.96 and the final answers 78.6% and 20.86%. Am I right? It should have been 20.86, 21.39 only. This is the total of this is 100%, right? So the total of these two should also have been 100%. I think there is something wrong here. 17.96. $20.87. Yeah, there is a small difference, you can say, in the total. This number should have been more appropriate is our answer, 21.39%. Because if you do the total of 78.61% and 21.39, then only your 100% will come. So this is the answer for 5 years bond. You can do the same for 20 years bond as well. For 20 years, these two are the answers, principal and interest. What they did in the presentation is they calculated the principal amount, the increment in the principal amount first with 5 years and 20 years, and then interest for 5 years and 20 years. My suggestion to you is take the 5-year bond, calculate the entire answer, take 20 years bond and then calculate the entire answer instead of getting confused. Okay, let's move on to the next question. Consider a bond selling at its par value. So if it is selling at its par value, we can say that face value is equal to market price is equal to 1000. Okay, with 6 years to maturity and 7% coupon rate. Okay, what did they say? 7% coupon rate. Can I say coupon rate will also be equal to YTM at 7%? Why? Because I'm assuming that the bond will be redeemed at par and face value, if face value is equal to market price, is given in the question. So I can say that coupon rate will also be equal to YTM. Okay, they are asking us to calculate the bond's duration. It's very simple. I don't know how did they have calculated, but we can do it with the formula. So they have calculated in this manner. Let me just, because this is the first question, I think instead of see, first I was planning to write down the answer of this question because this is the first question with all the 3 methods. But what I would prefer, in order to cover up the questions fast and the concepts also and all the 3 methods also, in every question I will take a different method for at least the coming 3 questions. In this question they have used this method of summation of ABC means they have used this method of summation of present value into year divided by summation of present value. So this is the total of present value into year divided by total of present value. Okay, this is the method that they have followed. We are going to do it in our way. It's very simple, and my suggestion to you is remember the formula. If you remember the formula, it is going to be the best thing. You can solve it easily. Otherwise, remembering the concept won't be a difficult task, but it is going to take a lot of time to solve the question in exam. And if you want to save the time, remember the formula. If it is causing you a problem to remember the formula and you think that you might make a mistake in plus minus sign, then go with the concept only. So first of all, let's write down face value 1000, market price 1000, time 5 years, am I right? 6 years. Coupon rate 7%, YTM 7%. Now if I write down the formula, it is duration is equal to, what is duration? Please understand the meaning of every word that I'm saying. Duration is the weighted average time in years, weighted average time in years of the future cash flows, of the present value of future cash flows, which says that in how much time we are recovering the present value of the bond. So 1 plus YTM divided by YTM plus, no sorry, it's minus here, and again 1 plus YTM plus coupon rate, time in bracket coupon rate minus YTM divided by coupon rate 1 plus YTM to the power T minus 1 and plus YTM. This is going to take some time to remember. 1.07 divided by 0.07 minus 1.07 plus 0. Why 0? I will tell you. Acha, let me write down in the total format. 6 into 0.07 minus 0.07. So this will make our calculation very easy. Then 0.07 in bracket 1.07 to the power 6 minus 1 plus 0.07. The good part about this question is the coupon rate and YTM are same. So every time you are using 7% only. Let's do the calculation. That goes to 15.29 minus 1.07 plus this entire second term will become 0, minus 0.07 minus 0.07 into 6 will be 0. Denominator 0.1051. So 15.29 minus 10.18 5.11 years will be the duration. Always remember that the duration will be always lower than the maturity period. The maturity period was 6 years, the duration is 5.11 years. This is how you have to calculate. If you can do that by remembering the formula, it's very easy. Otherwise, this concept is also here, 5.11 or 5.1 years in this case also. Right? What did they do in this part? Let me just clear it out. Create a table, write down 1, 2, 3, 4, 5, 6 years, then the coupon amount. You can write down all the coupon amount here. And in fact, you don't have to put this column of redemption. You can simply write down 1070 here. And instead of writing coupon payment, write down cash flows. Why to waste the time in exam? Okay, because you, in this particular table, because you have created this column, you also had to do the total of both the columns. Again wasting time. There is no need to. Just use the second column and then the present value factor at 7%. Why present value factor at 7%? If, write down here, in the compiler itself, please write it down. If market price is equal to face value and redemption is at par, then YTM will be equal to coupon rate, which is equal to 7%. Got it? Now you calculated the present value factors, and then what you did is calculated the present value. The present value is here, and then you calculated the present value also in this case. Now the problem in this question is, in this column is, this column is column number 1 multiplied by column number 2 multiplied by column number 3. All the three columns A, B, C have been multiplied. So this is nothing but some weight into years. No, that's not just the weight into years, it's present value into year. Simple, present value into year. See, so the total of summation of present value into year divided by summation of present value, which was 1000. They skipped a column in between. There should have been a column of present value. Instead of that, those bogus columns, there should have been a column of present value where you would have showed the total of 1000 at the end. So you go anyway, you can find out the answer. Let's go on to the third part. There will be many questions, so don't worry about it. We are going to practice. If the YTM of the bond in the B above increases to 10%, how it affects the bond's duration? Now tell me one thing. Take the same question number B, and increase the YTM from 7% to 10%. If the YTM is increasing, what will happen to the duration? Duration will go down. It will decrease. So there is an inverse relationship of duration with coupon rate and YTM. There is a direct relationship of duration. Write down in this part itself. This is what you have to write down in the compiler, sir. Is directly related to time till maturity. So if the maturity is higher, the duration will also be higher, directly proportional. But if coupon rate increases or YTM increases, the duration will go down. Let's have a look how. You can just practice it with the same method. See, in this part they have used proper columns, although they have missed on one column here, which is the present value. They should have calculated the present value, and that present value would have 868.85. Okay. Now if you do the total, it's very simple. Take the year, take the cash flows, take the present value factor at 10%, multiply the present value with the present value factor, and then multiply it with 1, you will get this answer. So this will be summation of present value into year. That you will keep in the numerator, 4366.45, and in the denominator only summation of present value, and you will get the duration 5.025. Earlier it was 5.10 or 11, and now it has been reduced. The duration of bond decreases, underline, reason being the receipt of slightly higher portion of one's investment on the same interval. So this is the answer for the third part. Now let's have a look on the fourth one. Why should the duration of a coupon carrying bond, coupon carrying bond, please write down coupon carrying, that means not a zero coupon bond. So this theory doesn't apply in a zero coupon bond where there are no coupons. So if a particular bond carries a coupon, means it has some certain coupon rate, then the duration of that bond will always be less than the time to its maturity. I just told you while solving the second part that the bond's maturity was 6 years and the duration was 5.11 years. Why so? Why always the duration is lesser than the maturity in coupon carrying bond? Why? It's very simple, sir. If we are investing in the bond and the bond's life is 6 years, we would want that our investment should be recovered as soon as possible. So it should be recovered before 6 years. And what is the meaning of duration? Duration means in how much time we are able to recover the present value of the bond. Present value of the bond is nothing but the amount that we are paying to buy the bond, to purchase the bond, right? So if we are investing something, we would want as soon as possible we should recover the money. So 5.11 years, it took 5.11 years just to recover our investment. And from 5511 years to 6 years, whatever we received was only our income. We can say that. So it should always be less than the maturity. Let's say, for example, if the maturity is 6 years, okay, in 6 years the bond will mature, and the logic says that it will take 8 years for you to recover. It will take 8 years for you to recover the investment itself. Will you invest in the bond? No, because once you invest today, and if it is going to take 8 years just to recover the investment, you know that you will not be getting a chance for 7 and 8 years to receive the cash flows, because before that itself the bond will expire. So nobody is going to pay you in 7th and 8th year, and that's confirmed that you are not going to recover the cost anytime. And if it is confirmed that you will be in losses only, why would you invest in the bond? Any investor would want his recovery of entire investment should be done before the maturity, and that's why the duration has to be lower than the expiry. Okay, question number 71 completed. Question number 72 is going to be the next question. Have a look. Today being 1st January 2019, Ram is considering to purchase an outstanding corporate bond having a face value of 1000 rupees that was issued on 1st January 2017. Focus on the dates. Today it's 1st January 2019, and the bond that we are talking about or that we want to purchase was issued 2 years back. Okay, which has 9.5% annual coupon. This is the coupon rate which will be applicable on 1000. So 95 rupees every year will be the interest amount. Okay, and 11 years of original maturity. What do you mean by original maturity? That means from the date of issue. We can clearly see that from the date of 2017, 11 years comes down to 2027 December. If I'm not wrong, let's calculate it here. 2, 3, 4, 5, 6, 7, 8, 9, 10. It is 1st January 2017. So this is going to be 1st January 2018, 19, 20, 21, 22, 23, 24, 25, 26 and 27. 1st January 27 will be the date where 10 years will complete. But the question says that the maturity is on 31st December. That is one more year, which is going to be 11th year. Are you okay with this? 1st January to 31st December, it will add one more year. Since the bond was issued, the interest, just a second. Now tell me one thing, how many years are still pending? Can we calculate it? Today is 1st January 2019. Obviously, 11 years has elapsed. 11 years was the original maturity. 2 years has elapsed. So 9 years are still remaining. Clear. From 2019 to 2027. But you should not calculate it directly from 2019 to 27. 19 is the 1st January and 27 is the 31st December. So one more year will be added. Since the bond was issued, the interest rate have been on downside. From that date, the interest have now fallen. And it is now selling at a premium of 1125.75. Because the YTM has gone down, the market price, which was 1000, is gone up at 1125.75. Determine the prevailing interest rate, means the today's YTM. Prevailing means, what do you mean by prevailing? Prevailing means the going interest rate. What is going in the market today? That is 1st January 2019. On the similar type of bond, if it is held till maturity, which shall be at par. Redemption is at par. And it's simple. The question is simply asking you, this is the bond. 9 years are left. YTM has to be calculated. You can calculate it in two ways, discounted cash flow method or the average method. In this question, I'm going to solve it by both the methods. See, first we'll take the easiest step. face value, market price, coupon rate. Okay, face value, market price, coupon rate, YTM and time. What is the face value? 1000. And market price? Market price 1125.75. Coupon rate 9.5%. YTM to be calculated. Time 9 years. Only 9 years are left, and that is the only thing important. Please understand, at any point if you are doing the calculation, the past does not matter. 2 years will not matter now. See, I will tell you. Although I am saying YTM can be calculated with both the methods, average and discounted cash flow, or you can say IRR. Without looking at the answer, I can clearly say that they have followed IRR. I will tell you why. Because you can see they have given some present value factors. And do you know why they have given this present value factor? And in fact, there are two different rates also given in the question. So from this point, you should understand and be smart here that they want you to use the trial and error method, and in that also assume these two rates only, 6% and 8%, and do the calculation. So in this question, I am not going to use the average method. And I will tell you one more thing. There might be chances that you will lose the marks if you use the average method, even though it is correct. But please understand the meaning of the question. If you use the average method, the entire purpose of giving this table gets defeated, and don't do that. Okay, so we are going to follow the IRR method. The very first thing that I will do before that is, I will just do the total of all the present value factors, so that it will help me in annuity calculation of annuity factors. So we'll do the total of it like this, 0.943. I can do it on the calculator also, but I will avoid it, because if the present value factors are given, it's better to do the total of these figures. I don't want to mess up myself in rounding off error. So it's 6.801. Okay. $6.246. Cool. Let's now go ahead and solve the question. What exactly we want to calculate? We want to calculate the yield. If we buy the bond at 1125.75, how much return we are going to earn. So we need to find out a YTM when the cash flows, at which the cash flows, if discounted, should bring the present value to a total of 1125.75. So this is going to be our target. At this YTM, this should be arrived. Okay. So at 6%, market price is equal to interest into annuity factor plus redemption value into present value factor. Interest is 95, am I right? And annuity factor is 6.801 plus redemption value is 0.592 . Let's solve it. 95 into 6.801, 646.1 plus redemption value 1000 into 0.592, that's 592. 1238.10. Now tell me one thing. Your purpose was to reach at 1125, and now you are at 1238. So you want to decrease the market price from 1238 to 1125. In order to decrease the market price, you will have to increase the YTM, inverse relationship, and that's why the second rate of 8% is given to you. Don't take 7% or 9% or anything else. Take this one only. There is a reason why they have given you the figures. 6.246 and 0.500. 593.37 plus 500. 1093. And you can clearly see your desired value is somewhere in between these two figures. 1093.37, this is 1125. Somewhere in between these two figures, 1238 and 1093, your desired market price is lying. So let's use the interpolation method. 6%, 8%, 1238.10, 1093.37. Find out the difference. What we are doing, we are just calculating that if we increase the interest rate by 2%, we will start from 6, because when we say we are increasing the interest rate by 2%, the base has to be there, na? 6%. From 6%, if we are increasing the interest rate by 2%, the market price is going down by 144 rupees. But we have to bring the market value down only till 1125.75. So how much should be the fall? Only 112 rupees 35 paisa. So this is going to be the answer, divided by, multiplied by. We will start with 6%. The increment of 2% in the YTM will bring the market price down by 144.73. But we had to bring it down only by 112.35. So multiply it and you will get the answer. .55%. This is the YTM when you discount the cash flows at 7.55%, the market price will be 1125.75. That means this is IRR. This is the percentage of return you will earn over a period of 9 years if you will invest in the bonds at 1125.75. If you buy the bond today, your rate of return will be 7.55%. Have a look on the answers. 7.55%. You can do the calculation. Please make sure you do the calculation in an equation format by taking interest into present value annuity factor, because 95 is a cash flow which is being repeated for all the 9 years. Do not follow this table value or table format in this case. Table format has to be followed only when the cash flows are different. When the cash flows are same, do not follow this, because it is going to eat up your time in exam. When coupon rate is same for all the years, do not follow table, waste of time. Okay, I am writing it in shortest possible manner. You should follow this one and this one. That's it. This is very easy, right? You will get the answer quickly in that case. Okay, the prevailing interest rate should be 7.55%. I don't know what is happening. See, I'm not doing anything, man. It's hanged. I will just have to take care of it, I think. Okay, let's move ahead. What the? See? Let me just restart this. I will just take a break and I will be back with the next question. Okay, so welcome back, and let's have a look on the another question. Question number 73. You are going to enjoy this. This is going to be on the new concept, that is realized yield. And actually it is not a new concept, but let's read it and then I will discuss about it. And it's very small, although XYZ Limited bond, which has a face value of 1000 and a 4 years to maturity, is currently trading at 900 rupees. carrying a coupon rate of 15%. Just have a look on what are the things given. Just a second. So there are 4 things: the face value 1000 rupees, market price which is lesser than the face value. If the market price is lesser than the face value, YTM will be higher than the coupon rate. Okay. Coupon rate is 15%, assuming that the reinvestment rate is 16%. It means that whatever cash flows you will be receiving after buying this bond, that means the coupon amount at 15%, it will be 150 rupees. All those coupon amounts can be reinvested at 16%. What you're required to do is to calculate the realized yield to maturity of the bond. Now, in order to calculate the realized yield, just write down in the bracket MIRR, and it is called as modified internal rate of return. This was done in your CA Inter. Nevertheless, I will just explain it again. Just a second. Charging is very important. Okay. So what the question is actually asking you. One, 2, 3, 4. I think 4 years only, right? So what will happen if you buy the bond today? You will be investing 900 rupees, right? 900 rupees today, and then you will be getting 150 here, 150 here, 150 here, and 150 here. Also, the redemption value will be 1000 here. Okay. Now, they are asking you to find out the realized yield in the manner that they are asking realized yield to maturity of the bond, and they are also giving you the reinvestment rate. From that sentence, I assumed, or we can say I got an idea that they want me to reinvest the interval cash flows, the cash flows that I am receiving meanwhile. That means, see, what is going to happen? This 150 will be invested. The moment I will receive 150 after 1 year, I will invest it for the next 3 years. 3 years at 16%. I will be getting interest on that. Again, after 1 year, 1 more year, I will receive 150 and I will invest that for another 2 years at 16%. Again, I will be receiving 150 in the 3rd year and I will invest that for another 1 year at 16%. And I don't have to invest this amount for the same date because I'm already receiving it at the end. Okay. So all in all, what will happen? Just understand, I will just do the calculation. Can I say that 16% for 3 years, how much money 150 will become after 3 years? This is, let's say for example, this is a principal amount. We have to calculate the compound amount. What is the formula for that? Compound amount is equal to principal in bracket 1 plus r to the power t. I'm not taking n number of compounding because there is no need to. So if we do the calculation, 150 in bracket 1.16 to the power 3, am I right? 1.16. So 150 in bracket 1.560 or 561. It will make that 150 to 234.15 at the end of 4th year. Similar will be the calculation for this 150. 150 into 1.16 to the power 2. 150 into 1.346. 201.90. And this one 150 into 1.16. 170 4. So at the end of, understand, at the end of 4th year, I will have this cash flow, this one, and this one. The total will be, because it is of the same date, 150 plus 1000 plus 174 plus 201.90, 234.14, 1760.04. Okay. In the beginning you invested 900 rupees, and now the question is asking you what is your realized yield, means at what rate this 900 will become 1760 per annum. 1760.04 in 4 years. What is the exact return that you have earned from the start of the investment till the end of the investment, considering whatever you have received meanwhile was reinvested? You did not keep that cash flow. So 150 was cash inflow at the end of first year. It was the cash outflow as you reinvested. So you received it, you paid it back. You received it, you paid it back in the second year as well, in the third year as well. So the only cash flows that went into your pocket are, this is outflow in the beginning and the end one, 1760. Now the question wants to know, and the entire public wants to know, how much you earned. The rate of return, or the rate which will make this 900 to 1760.04 in 4 years, will be your realized yield, and the same will be calculated using the compound amount formula. Have a look. Compound amount means the future value 0.04, principal 900, and you have to calculate the rate of interest for in 4 years. That's simple. So it comes to 1.9556 is equal to 1 plus r to the power 4. If you bring that 4 on that side, this side, left side, it will look like this. To the power 1 by 4 is equal to 1 plus r. Again, 1.9556 is nothing but 1 by 2 into 1 by 2 is equal to 1 plus r. This is nothing but 1 by, to the power 1 by 2 is nothing but the square root. So what you have to do is you have to press the square root button 2 times. See how it's done. I will show it to you in the calculator or in the, give me a second just. Can you see this? I will just bring it up to this level. Okay. So 1.9556 on the calculator, and then you are going to press this square root button, this one 2 times, because there are 2 times square root, 1, 2. The answer is 1.1826, round off. 1.1826. 1.1826 is equal to 1 plus r. So r will be 18.26% per annum. You can cross check this. You should in fact cross check it in the exam, if whether you have made a mistake somewhere in between the steps 2, 3, 4, 5, 6. If you have made a mistake, your answer won't tally. So let's do it again. Put down 900 in bracket 1.1826 to the power 4. So 1.1826 into 234. 900 into 900. The answer comes to 1760 in the calculator itself. I can save the time. 1760. My answer is done. That's it. 1 by 2. 1 by 2 means the square root. So I have done it twice. How much is the rate? 18.26%. In this table it is 18.30. So that's the rounding off difference. I will tell you why the rounding off is there. See, you can clearly see they have taken it as 1.956. We have taken it as 9556. In our answer it was 9556. So they rounded it to 3 decimals. We did it to 4 decimals, and that's why the minute difference is there. That will be considered in the exam, so no need to worry about that. Okay. One doubt that lots of students will ask here is, what if This 1.183 would have been, let's say, if the maturity of the total bond is, instead of 4 years, it is, let's say, 5 years. So at that time, what will you do? We cannot do the square root 2 times now. Okay, so there is another way to that. Put down, or I will just show it to you here, 1.183, and I will show it to you with 1 by 4 itself, because I can cross check that answer with the answer that you have received here. Okay, not 183, just a second. 183 is the final answer, man. I don't know why they have taken to the power 1 by 4 there. So just remove it. 1 by 4. It should be 1 by 4 on 1.956. Okay. So what if 1.956 would have been 1 to the power 5 to the power 1 by 5? So we can do it like this: 1.956. Keep it on the calculator. Let's say if it is 1 by 4, so I will keep 1.956 on the calculator, and then I will press square root button 12 times. Okay, then I will press -1, then I will press divided by 4, whatever is there in the denominator. 1 by 4, so then divided by 4. 1 by 6 divided by 6, plus 1 multiplied by equal to 12 times. Now I will show it to you here. Have a look. I'm going to do it, but first make sure that your calculator is clear with all the memories. There should be no m plus minus something there. Okay, so let's put down 1.956 on the calculator, and then square root button 12 times. 1 2 3 4 5 6 7 8 9 10 11 12. No other button should be pressed. Okay, now minus 1. Okay, no other button. Don't press this equal to button. Lots of people makes this mistake. I have not written equal to there, and still you are doing it. Okay, I will just make it to this level. What is the next step then? After that, the next step is to just have a look here. The next step is to divide it by 4. So divide by 4. Okay, then plus 1, then into equal to 12 times, into equal to 1 2 3 4 5 6 7 8 9 10 11 12. You can clearly see that 1.1826 is the answer. So that is 18.26%. 18.26%. That's what we calculated. So any power, let it be any power, you can calculate with this formula, with this method. Any figure with any power can be calculated on the calculator with this steps. Okay, shall we move ahead? So this was called as MIRR, modified internal rate of return. Question number 74. Let me see. Yeah, there is something new that we are going to learn in this question, so have a look on this part. The following data are available for a bond. Okay. So the face value is given to you 1000 rupees, coupon rate 16%, and if you calculate the coupon amount, it will be 160 rupees. 6 years are there till maturity. Redemption value is also at par. YTM is 17%. Now if I ask you to calculate the market price, whether it will be higher than the face value or lower than the face value, you can see YTM is greater than coupon rate. Redemption is at par. You can clearly say the market price will be lesser than the face value. So it will be something below 1000 rupees. Now, what is exactly the question is asking us? What is the current market price, duration and volatility of this bond? See, current market price you can easily calculate. Duration also you can calculate. But this is a new concept which is called as volatility. This is also called as, please mark it here and write down, modified duration. This is nothing but modified duration. This was Macaulay's duration. Now let's first complete the two parts, current market price and duration, and then we will find out what is the meaning of volatility. Also calculate the expected market price if increase in the required yield. If the required yield means YTM is increasing, the market price will again fall. So the required yield, increase in the required yield is 75 basis point. What does that mean? It means 0.75%. Okay, one of the worst thing that they have done is calculated the market price with average method. Don't do it. Never ever do it. Follow this approach only. The present value approach. We have seen a lot of questions with that. You can calculate it easily. Just take the interest and then present value annuity factor, redemption and the present value factor at YTM. You got the market price of 964.24, and then you will calculate the duration. To calculate the duration, there are three different methods. Summation of present value into year divided by summation of present value. You can calculate it by this method also, summation of weight into years, weight of the present value. And then there is one formula, big formula. Let's see what they have done here. Year, they have taken year 16 and the cash flows. Present value, this is the present value of the cash flows. Then they have taken the weights and then weight into time. So what they have done is summation of weight into years. This is the best approach. I will tell you, this is the best approach. Try solving couple of questions with this approach and you will get the answer easily. Other than that, if you want to do it fast, then I think the formula will help you a lot in that manner. So what is the formula? You have to remember it. 1 plus YTM divided by YTM minus again 1 plus YTM plus time coupon minus YTM divided by coupon outside the bracket 1 plus YTM to the power number of years minus 1 plus YTM. So if you can remember the formula, go with this. The duration of the bond is also clear. I'm not repeating this because we have seen such questions in the past also. So I'm moving ahead from this point. I'm just focusing on what we have to learn in this question. We have already learned about how to calculate the market price and the duration also. Now comes the volatility. See, question 74. Volatility is equal to duration divided by 1 plus YTM. This is the formula, and what exactly it is, I will tell you the meaning of it. What is the duration? Duration is 4.247 years. So 4.247. And what was the YTM? The current YTM, 1.17%. 17%, right? Am I right? 17% was the YTM. So if you do this calculation, if you divide the duration with YTM, you will get a figure. 4.247 divided by 1.17. So that goes to 3.63%. 3.63%. Am I right? Let me just check the answers. 3.63%. Simply follow this volatility. Okay. Now we will now write down what is the meaning of the volatility. 3.63% will show the market price change when 1% of YTM will change. So write it down along with me. Volatility represents the change in market price for every 1% change in YTM. Okay, but please understand, since market price and YTM are inversely related, so if the YTM is increasing, the market price will decrease. So I can write down volatility represents the opposite change in market price for every 1% change in YTM. So if, let's understand, if the YTM is increasing by 1%, market price will go down by this much percent approximately. This is more important because it doesn't give you the actual figure, but it gives you the approximate figure. So 3.63% will be fall in the market price if 1% is increase in the YTM. Just understand this. If a YTM is increasing by 1%, market price will go down by 3.63%. Let's try it. Try to solve it, prove it in fact. So our volatility was 3.63%, right? What we can do is, let's find out the market price again. Interest into present value annuity factor plus present value into present value factor, or redemption value into present value factor. Okay. Now let's do one thing. We should increase the interest rate to 18%. Let's increase the interest rate to 18%, and that is for 6 years. Am I right? Okay. So interest amount was 160, 16% coupon rate into, and the redemption was 1000. Let's find out the annuity factors at 18%. 1 divided by 1.18 equal to m plus 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 and equal to m plus. Okay, so that's 0.370 here and 3.498 here. 559.68 plus 370. Let's do the total. 929.68. Now understand. At 17% there was a market price which was, do you agree with this? 964.24. At 17% the market price was 964.24, and at 18% the market price is 929.68. How much is the increase in percentage in YTM? 1. And how much is the decrease in the market price? Let's find out. Market price has gone down by 34.56 rupees. So let's calculate the percentage, which is 34.56 gone down, 964.24 into 100. 3.58%. So the moment we increase the YTM to 1%, the market price will go down by 3.58%, and the answer for the volatility was also almost near to 3.58 what we said. See, you can see these two answers are almost close to each other, and that's why I told you they will not be accurate. That's why the approximate word is important in this case. Approximate word is important in this case. So volatility means the percentage change in market price. Volatility means the percentage change in market price in opposite direction for every 1% change in YTM. That is the sole meaning of it. And with the help of this third part, we are going to find out the answer for the fourth part, because the fourth part says that what will be the change expected market price if the increase in required yield is by 75 basis point. Now, let me tell you one thing. If YTM is increasing by 1%, market price will go down by 3.63% as per the volatility's definition. And what if the market price, and what if the volatility is decreasing or increasing only by 0.75%? Not wholly by 1%, but only by 0.75%. Then what will be the change in the market price? It's very simple, sir. Multiply 3.63 with 0.75 and you will get the answer of change in market price. That is called as cross calculation. For 1% change, 3.63 is the change in the market price, and for 0.75 how much will be? So 3.63 into 0.75, that will give you the answer 2.7225. So for 0.75% increase in the YTM, market price will go down by 2.7225% from this, the original price. So what you are going to do? The new market price will be 964.24 less 2.7225%. That's it. You don't have to do all the calculations again. Sorry, 17%, don't make it 17.75 and start doing all the calculations. There is a new concept that we have learned just now, which will reduce your calculation to a maximum level. With the help of the volatility, you can easily calculate the new market price. You don't have to do all the calculations again, making 17 to 17.75% and then calculating the annuity factor and then present value factor and doing the total and summation and then arriving at the value. No, 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 no. Volatility will be used and has to be used. Only then the paper checker will get to know that you know the meaning of volatility and you have not just mug up the formulas and came into the exam and then wrote the paper. See. The expected market price if increase in required yield is by 75 basis point. So 0.75 into 3.63. Okay, this is the change. They have taken 960.26 as the market price, which was calculated with the average method. I won't suggest this. So go with the 964 value. So accordingly, the answers will be there. So this is going to help you. This is what I am talking about. Go with this. 964.40 into this much of the percent means this is going to be the fall in the market price. So if you reduce the market price with this much, 938.14 will be the answer. Understood the concept of volatility? Volatility will give you the change in market price for every 1% change in YTM, but in opposite direction. If the YTM is increasing, market price will decrease. If the YTM is decreasing, market price will increase. So this is something new that we learned in this question. Question number 75. Have a look. It is exactly same. You can calculate the current market price with the same method. See. Interest into redemption, present value annuity factor plus redemption value into present value factor. What is the YTM in this case? 15%. 110 will be the coupon amount. The number of years are same. Redemption is also at par. Okay. Then the duration of the bond, you have three different methods to calculate the duration of the bond. The only thing which is required is the practice. Practice makes man perfect. Then you calculate the volatility of the duration, duration divided by 1 plus YTM. You can easily calculate the volatility. With this third part, this third part's answer will be used in fourth and fifth part. Make sure you use it. So expected market price if increase in yield is by 100 basis point, that means 1%. If 1% is increase in the YTM, the decrease in market price will be exactly the answer of the third part. And if the market price, we have to calculate the market price if the decrease in yield by 0.75. It is the same thing that we did in the previous question. See. So 834, again I will tell you, don't use this method. Use the present value technique. Use present value method. Don't use it ever. Okay. Then duration using this method, or you can use the another method also, which is the formula. What are the three methods? Please remind me. Summation of weight into years. In this, they have done the same thing. This has been followed in this question. Then summation of present value into years divided by summation of present value, and then there is some formula, 1 plus YTM divided by YTM minus 1 plus YTM in the numerator plus time in bracket coupon rate minus YTM divided by coupon rate will be outside, then in bracket 1 plus YTM to the power T minus 1 and then the bracket closed, then plus YTM. So this is how you have to remind, like you have to mug it up in a sense. Then comes the volatility. Volatility is 3.974%. See. So if the volatility is 3.974%, it means if the YTM goes up by 1%, market price will go down by 3.974%. Okay. So 3.974 of 834 comes to this. That means the market price will go down by this much amount. Down means the minus sign should be there. And in the second part, in this case the YTM is decreasing, market price will go up with this much. So the amount will be this much, 0.75 into 3.974. The proportionate percentage or the proportionate volatility we can say. And it will go up. There will be a plus sign because the YTM is going down, market price will go up. Let me correct few things. Okay, not an issue. Let's go ahead. Question number 76. See, if there is anything new to learn in this question, face value 10,000 to be redeemed at par on maturity, coupon rate 8.5%, YT years to maturity 5 years, YTM they have given as 10%. Now you may ask one thing, sir, if the face value is 10,000 and it's to be redeemed at par, okay, chalo, let's leave it. I will talk about it later. So these are the details given to you. Can you calculate the current market price of the bond? It is going to be the same present value of future cash flows. Then you can calculate the Macaulay's duration with the 3 different formulas. Then you calculate the volatility also. Now comes the point of convexity. This is something new that you should learn. Now what is the meaning of convexity? Convexity will give you the same thing as the volatility was giving you. But there was some problem with the volatility. Do you remember that problem? I will tell you that problem. In the previous question, when I gave you this example, do you remember that when we actually increased the market price by 1% from 17 to 18, we found that the change in the market price was 3.58%. And I told you that the volatility will give you the same answer, but approximately, not accurately. So the difference between these two, 3.63 and 3.58%, this is the error with the concept of volatility. Do you get it? There is some problem or the drawback in the volatility concept. It shows us the change in the market price, but it doesn't give us the answer accurately. So this error between the answer, the difference between the answer is being reduced and solved by a new concept called as convexity. So convexity is exactly like the volatility. Obviously the formula is different. Convexity is exactly like the volatility, but it overcomes to maximum extent, not entirely, obviously. It overcomes to a maximum extent the error or the drawback of the modified duration concept. The drawback was volatility gives you the approximate change in the market price, not the accurate change. The accurate change is mostly given by the convexity. Do you understand the reason why there is a next concept of convexity? Now, if you will look at the formula, you will have to just open up the charts and see. We have seen the formulas of duration, we have seen the formulas of modified duration as well, and because there is modified duration, we have a convexity. Let's read a couple of lines. Modified duration is a good approximation of the percentage price change for a small change in the interest. Have a look. What they are talking about in the convexity is about the modified duration. They are saying that this is a good method. This is a good method to find out what will be the change in the market price if the YTM is changing by a small percentage. But however, the change cannot be estimated so accurately of convexity effect as the duration based estimation assumes a linear relationship. What does that mean? Is it won't give you the appropriate or accurate answers if you increase the change in the YTM. With 1% change in the YTM, I think volatility will give you a good answer, more appropriate answer. But if you change the YTM by 5% and then you expect to find out a better answer with the help of volatility, you won't get it. Okay, let me just prove it to you. Instead of just talking and talking and talking, let's prove this. And then we will shift to the convexity concept. I will take this same example. We increase the market YTM by 1%. Let's change it and increase the YTM by 5%. Okay. So have a look. I will do the calculations again. I will calculate the market price. I will take the interest as 160 rupees because 16% was the coupon rate. and I will calculate the present value annuity factor. 17% was the YTM at that time. 17 plus 5, 22% for 6 years, right? That was the example at that time. And then 1000 was the redemption value, present value factor, 22% for 6. This is going to give you the exact market price. Now, before doing this calculation, let's go ahead and find out what should be the answer according to volatility. Volatility says that for every 1% change in the YTM, 3.63% will be the change in the market price. Now, YTM market price, 1%, 3.63%. Now we are saying that what will be the change in the market price if the YTM changes by 5%? Let's just simply multiply it. And the answer should be 18.15%. Okay. Volatility is saying that your market price should decrease by 18.15% because YTM has increased by 5%. This is the answer by volatility. Let's find out the real answer now. 1 divided by 1.22. So 160 into plus 1000 into 0.303 is the present value factor and 3.167 is the annuity factor. So this is 506.72 plus 303. So that goes to 809.72, right? This is the market price. Now, at 17%, the market price was something like, what was that? 964.24. And now at 22%, it is 809.72. Let's find out. The change in the YTM is 5%. 964.24. And the change in the market price is 154.52. How much is this in percentage? 154.52 divided by 964.24. The answer is 16.03%. 16.03%. And your answer according to the volatility was 18.15%. Now you tell me one thing. The real change in the market price is only 16%, but volatility now is giving you the wrong answer. 2% of the difference. 16 and 18 is too much of the difference, man. Right? So will you rely on the answers by volatility if the change in the YTM is higher, like let's say 5%, 6%? No, at that time volatility cannot be relied upon, and that's what exactly the convexity says. This estimation can be improved by an adjustment on account of convexity. We are going to adjust that 18%. That 18% will be adjusted now. See, you will understand the ultimate formula for percentage change in present value is this. Okay, and what is this formula? Minus, it starts with minus sign. Why? I will tell you. Because if YTM is increasing, market price should go down. And YTM is decreasing, market price should go up. So there should be opposite effect. And that's why every figure when you multiply with minus will give you the opposite answer. And that's why in order to take the relationship between YTM and market price, they have given you the minus sign. Otherwise, there is nothing else. We are starting the concept of convexity with the annual modified duration. Means the answer that we calculated here will be the base. So that's mean 18.15% is still important for us, but we are going to adjust that 18.15% to bring it to somewhere near 16.03, because the real answer is 16.03, right? So we have to adjust that 18.15%. We will start with this 18.15. Have a look. We will start with this 18.15. Then we will multiply it with the change in YTM. Whatever the change was there in the YTM, that 5% was there. Plus, have a look on this, plus the convexity. This is called as the adjustment factor. This is what we are adjusting. How we will calculate this, I will tell you in a moment. Convexity into change in yield square. So please understand, multiplied by change in yield, and on that side change in yield square, multiplied by change in yield square. Now the convexity in the bracket, this point has to be calculated first, and this will be calculated using this method. Convexity is equal to, I will just show you how we arrived at this formula. Present value when the YTM is increasing. What do you mean by plus sign? See, read it here. Bond price on increase in yield. Present value minus means bond price on increase. Oh, write down. Just a correction. On decrease in yield. Do the correction in your charts also. PV minus means the price of the bond when you decrease the yield. Price of the bond when you increase the yield. Minus 2 into present value at no change in the yield, or means current yield. PV0 means initial bond price, means at the bond price at 17%, you can say, divided by 2 into PV0 into change in yield square. So this formula is little tough to remember, but there is no other option, and you have to practice a lot so that you can score the marks in exam. Come over to the concept of convexity. We will just discuss it further and come to the formula. All in all, the objective and the purpose of convexity is to adjust that 18 point something percent of the volatility which was giving us the wrong answer to 16% or somewhere near the 16%, so that we can get more accurate answer. I won't say accurate enough, but a better answer than 18%. So that's what the convexity does. Let's have a look on certain examples now.